I'm going to break down the 3 accounts that you need to open as soon as possible. The first one is just a standard checking account. If you do not have one, go get one. This is your everyday account. This is one that you're going to be using with all just the ebbs and flows of money. A standard checking account is like inevitable. You're most likely going to have to get one because most employers have direct deposit for jobs. I'm actually an employer. I own a hotel with a business partner of mine. And in previous companies that I've done accounting for, we require direct deposit. Nowadays, I just do not ever write checks for any of my staff. It is a direct deposit, so you have to have a checking account. Now you want a standard checking account as well for certain bills that will be paid directly from that checking account. So if you own a home, you're going to want a checking account because most likely it's just going to be auto debited from your checking account to pay your mortgage. There are also other bills that you just have to pay using a checking account. Sometimes utility companies won't allow you to pay with a credit card, so you have to pay using your checking account. So if you do not have a checking account, go and get one. You're going to need it in your life. Now for me, I actually use my checking account and I keep a very small balance in my checking account because I want my money and any excess money that I have to be working for me. And so the checking account, as it's just for the ebbs and flows of paying off my bills, my mortgages, I just keep enough in there to handle those things. So typically my checking account runs a balance of about $1,000. Now, obviously I have a credit card bill that'll hit once a month that is a little bit higher than that. And I pay off my credit card bill in its entirety every single month. So I just make sure that there is enough in that checking account to handle any incoming expenses. And I just make sure that I have the bare minimum in this account because typically checking accounts do not make any interest. Now I recognize to be able to do this, you're going to have to do some planning on your part. So that is why budgeting is super important. Knowing when and how much money you are going to be sending out to others is vital so that you always have enough in that checking account. You do not want that checking account to go below zero because then you are going to be charged insufficient fund fees, and those can add up quickly. So understand when large expenses hit and make sure that you have enough money in there. Once you have watched it for a few months and you understand the flow of money when you get it and when it gets sent out, then take any excess money that you have in there and throw it into the second account, which I'm going to hit on in just a second. But if you have not opened a checking account, it's very, very simple. Go find a local bank or a credit union. You can do a national bank as well. Just make sure that you have one that is in your town. You don't have to because everything is going so digital these days, but I like to have a physical location that if I need to, I can walk in and ask questions for. But that's it. I mean, I don't hardly ever deposit checks, and if I do, you can just take a picture from your phone. They have mobile apps. Almost every single bank or credit union is going to have a mobile app where you can do deposits using that. But it's nice to know that if you need to, you can walk into a bank. All right, account number 2 is a high interest savings account. This is where you're going to park all of your money that's for an emergency fund and 6 months worth of living expenses. So if you follow Dave Ramsey at all, or even if you don't, you should have an emergency fund of at least $1,000. That way you know if something happens, if your car tire blows up, you need some quick money, you have that set aside for an emergency and you can use it. Now I put that in a high interest savings account so that it's making money as it's just sitting there. And then you're going to want to build up at least 6 months worth of living expenses. Now this is more long-term. You're thinking, okay, what if I lose my job or what if I get injured and can't go to work for a while? This is where you're going to want 6 months worth of living expenses. Once again, put it into a high interest savings account so your money is working for you, at least keeping up with inflation. Because if you just leave it in a checking account, inflation is making your money worth less and less every single day. So at least be earning some interest off of your money by putting it into a high yield savings account. And typically I do not like to put this money into like a CD, or that's a certificate of deposit. You can do it with a lot of banks. Typically they don't give you very much interest. Honestly, right now they might be at like 2%. I'm actually going to pull up Wells Fargo's and check that out. So I'm looking at it right now. This is a 3-month standard fixed rate. Standard interest rate is 2%. The problem with the CD is it requires you to leave that money in for a certain period of time. So you can do 3 months, 6 months, 12 months, 18 months. I mean, you can go up to years on these things, but it locks your money down. That's why I like to find a good online high interest savings account, because you can put that money in there and it's liquid, meaning you can take it out whenever you want to. Now, if you need it, that's where a CD is not going to help, because your money will be locked down. Whereas a high interest savings account, you can pull that money whenever you need it. Another awesome thing about these high interest savings accounts right now is they actually give you very high interest rates. So this CD right now for 3 months is 2%. I've used CIT Bank, and I've also had an account with Marcus by Goldman Sachs. I like both of them. Right now I have my high interest savings account with CIT Bank. There are multiple of them. You could go search high interest savings account and you'd be able to find a bunch. But for example, right here in CIT Bank, a platinum savings is paying 4.55% on your money. Now that is with a balance of $5,000 or more. So if you have that $5,000, this is a great option. If you don't have that $5,000, CIT Bank actually still has an account called Savings Connect where you get 4.2% on your savings, and that has no minimum balance. So anything you put in there is going to be making 4.2%. So go find a high interest savings account, put your emergency fund and any excess, like if you have a 6 months living expenses saved up, put that into your high interest savings account. All right, account number 3 is actually a lump of a few different accounts. So either a Roth IRA, a traditional IRA, a 401k, or an HSA. IRAs are individual retirement accounts. 401k, that is a company sponsored retirement account. And then an HSA is a health savings account. So you can choose one of these. You can choose all of them. There are some limits on how much you can contribute with a Roth IRA and a traditional IRA. And you have to watch those closely if you are also contributing into a company sponsored 401k. And then HSAs have limits as well. So I'm lumping all of these together because these are all investment accounts. So if you are an employee and your company offers a 401k and it offers a match, you should 100% open a 401k. Now, a company match is where they say if you contribute money, we will match to a certain point the money that you contribute, and we will contribute into your retirement account as well. Typically what that'll be is like a lot of companies will be like, okay, if you contribute 3%, we'll contribute up to 2%, or we'll match you percentage up to 3%, and then we'll stop. So if that is the case, you need to open a 401k and you need to contribute at least up to the max where you can get the max company match on that. Otherwise, you're throwing away free money. They're saying, hey, if you contribute $100, we'll put $100 in as well. If you don't contribute anything, then you don't get that $100 and you've just lost out on money. So if your company offers a 401k and it has a match, you should 100% open up a 401k and max that out to get the company match. If you do not have a 401k at your company, then open either a Roth or a traditional IRA. Roth versus traditional is very simple. Traditional is pre-tax. That means any money that you put in this year, you will not be taxed on. So the government's just going to pretend like you didn't make that money this year. You are not taxed on it. Now, fast forward to retirement age, when you start pulling money out of your traditional IRA, then you are taxed on it. So it's postponing the tax until later. Now, a Roth IRA is a little bit different. It is going in post-tax. So the government's saying, yes, you made that money this year, and yes, you are going to be taxed on it. But you can put it into this retirement account. Now, the cool thing about a Roth IRA is as that retirement account grows, when you go and pull that money out when you're retired, any growth that you have seen in that, when you pull the money out, that is not taxed. Now, in a traditional IRA, the growth that you have is taxed when you pull it out, but not in a Roth IRA, which is really cool because most of your money is going to come through growth if you start investing early. So to show you this, I'm going to bust out this investment calculator. So this is saying you have $0 in your starting investment. You're going to invest for 30 years. Say you're starting to invest at age 35, which is how old I am. I'm going to invest for 30 years. By the time I retire at 65, Now I'm going to do a 10% return. That's the average return on the S&P 500 is 10 to 12% annually. And I'm going to do $500 a month. Now, if I bust out that calculation, my total contributions is $180,000, but my ending balance is $1 million. So I have $850,000 in earnings off of that Roth IRA. Now, if I were taxed on that, and I'm pulling it out, say I'm taxed at 15%, I'm going to lose out on $127,000 by having it in a traditional IRA. That's where all of that growth would be taxed. Now, a Roth IRA, that growth is not taxed because you were taxed on the money before you contributed it, and because you are saving for retirement, the government's going to say we're not going to tax on that. So I actually really like a Roth IRA. That is what I'm going to be focusing on along with my real estate. Roth IRA, you save a ton of money on taxes when you go and pull it out. To open up a Roth or a traditional IRA, there's many different investment accounts. I go with Charles Schwab. They're not giving me money to say this. I actually really like them. I think that's where I started off, and I just got used to their platform. It's very, very easy to open an account. You can do it in like 10 minutes. Just go to charlesschwab.com and look up Roth IRA and bust one out. So we've talked about traditional and Roth. Those things are also available in 401ks. You can have a Roth 401k where you can still have any investment growth. You can pull it out tax-free as long as your company provides that option. One of the really cool things though is Roth, you're taxed before you put the money in. Traditional, you're taxed after you pull the money out. There is a thing called a health savings account. And a lot of times people use this to save up for medical expenses. But the cool thing is this is an amazing investment account because any money that you put in is tax-free. But any money that you pull out, if it is going towards qualified medical expenses, it is also tax-free. So you are getting the benefit of both a Roth and a traditional IRA by using a health savings account. Now that caveat is that you have to use those expenses to pay for qualified medical expenses. But when you get older, when you go to retire, those medical expenses are going to be there. So if you can max out your HSA every single year and contribute into it, by the time you retire, you're going to have a huge chunk of change sitting in that HSA, and any medical expenses that you have are going to be able to be paid completely tax-free. Now, there are limits on how much you can contribute into Roth and traditional IRAs and HSAs. For an HSA, it is $4,150 for an individual or $8,300 for a family. Every single year you can put that in. That money will go in completely tax-free. The government will pretend like you didn't make it that year and you're not going to be taxed on it. And if you pull it out to pay for medical expenses, you're golden. On these investment accounts, the key is to start now. Invest early and invest often. There's a saying that's like, when's the best time to invest in the stock market? Well, it was 20 years ago, but the second best time to invest in the stock market is today. Don't worry about all the ups and downs. You just put it in. Don't be emotional about the money. If you see a dip in the stock market, keep going, keep investing often and early. As a quick show of how just investing early works, check this out. So if I go back to the investment calculator, I'm going to invest from 35 to 65. So that's 30 years of investment. I'm going to do $500 a month. That gets me $1 million by the time I retire. If I were to say, you know what, I'm going to wait 15 years. I'm not going to invest for 30 years. I'm going to do it for 15 years, but I'm going to bust out and I'm actually going to double my contributions. I'm going to invest $1,000 a month at that point because maybe I'll be a little more financially secure. Maybe that's your thought process, is like, I'm going to wait to invest because I want money now. Check this out, how your retirement's going to end. If I redo that, you're only going to have $398,000 when you retire, even though your total contributions are the same. You are still contributing $180,000, but because you waited for 15 years to start investing, you're losing out on 60% of your total net worth. At that point, you're going to drop from $1 million down to $400,000. So start early. So if you are sitting in high school right now, and I hope we have high schoolers watching this video. If you are, hit me up in the comment section. Even early college, like, let me know how old you guys are. Hit me up in that comment section. But if you can invest for 40 years and drop that back down to that 500, Check this out, $2.7 million, almost 2.8. That is a huge difference just by starting to invest early. So as a recap, if you have not already, get a checking account, get a high interest savings account, put your emergency fund in there. You know, if you have any money in excess of that emergency fund and 6 months worth of living expenses, go open an investment account and start investing now. If you guys have any questions, hit me up in the comment section. We'll catch you guys next time.